Hey folks, I hope your day's going well. Wanted to reach out today and talk just a little bit about some of the pitfalls that people can fall into when they have gotten pre-approved for a loan, made an offer on a home, and had that offer accepted. Now, at that point, you've done so much that you feel like, well, you're almost there. And you are. You're well on your way. But there are some things that can happen that can make it very difficult to actually complete the process. So we're going to look at 6 things that could trip you up if you're not careful. Now, as we look at these, some of them may seem a little counterintuitive. Some of them we just have to understand how things look from the point of view of your lender. And that's really what we're focusing on here. How does your lender see what's taking place? So the first thing that we're gonna focus on is don't deposit cash into your bank accounts. Now, we might first think, well, wouldn't that look good that suddenly we have more cash in the bank account? And for us, yeah, that seems like a good thing. Maybe we went out and sold a car or somehow sold something that had value and we dropped that money into the bank account. However, the lender may look at that and say, well, where did this money come from? Did his cousin lend him this money so that he can help buy this house? Does he have to pay this money back to his cousin? Well, from the lender's point of view, that money itself is not a bad thing, but they need to understand the source of the money. Where did it come from? And cash is hard to trace. It's hard to explain. So don't deposit cash into your bank account without first talking to your lender about it. Your lender may be able to help you see how to document that so that when you actually apply for the loan, you close the deal, you apply for the loan, everything is already in place. So that's an important thing. So that's number one. Don't deposit cash into your bank account. Now, the second one we're going to focus on is don't make any large purchases, like a new car or furniture. Now, that furniture one, it's kind of a tough deal to my thinking because you just bought a new home or you have had your offer accepted on a new home. It's bigger than your old one. You need new furniture. And they've got a great sale going down at the furniture store. So it's easy to go down there and make that purchase because you're confident that you're going to get into your home. The problem is that new debt, if you had to pay for that on credit, then that debt brings on new monthly obligations. And your lender is going to have to look at those total obligations that you have relative to your income, or what they call the debt to income ratio. Now, by making a large purchase, you have adjusted that debt to income ratio. You have more debt relative to your income, and that may keep you from getting the loan. Now, that would create a painfully ironic situation. You now have purchased new furniture for the home, but because of that, you can't get the home. Well, that's not where you want to be. So wait. Don't go out and spend that money on the furniture for the home or a purchase of a new car yet. Those things will still be there when the time comes, and you can do it without compromising your loan. The third thing, don't co-sign other loans for anyone. Now, that's a tough one. It really is. Because you're excited. You feel good about where you are. You qualified for this loan. You've had your offer accepted on a home. And now your daughter, your son, a friend comes to you and says, we're just trying to get some new tires for the car. Would you co-sign this loan? And we want to help them out. This is someone we know and we love and we trust. The problem is that once you put your name on that loan application, you're obligated. And that changes your debt to income ratio, just like you went out and bought new furniture for the house. So you love them, great. But this is not the time to co-sign for anyone. It will compromise your ability to get into your home. Now, the third thing is the fourth thing rather, is don't change bank accounts. Remember, lenders need to see the source of your income. They need to be able to track that income and understand where it's come from. If they can look back and say that you've been with Bank X for 5 years or 10 years or 15 years, then they're able to see the money coming in and going out, and it's easy for them to understand. If you change banks, you may have just erased a whole lot of that accessible history, and that may complicate matters. So before you make changes or transfer money, talk to your loan officer. The fifth thing, don't apply for new credit. Now, it doesn't matter if you're looking for a new credit card or a new car. If you open new credit, it's going to impact your credit score, because now you have a changed ratio of debt and the used available credit. Those things will hurt you. It will lower your credit score. It may increase your interest rates. It might even disqualify you for getting your mortgage. So don't open any new credit accounts. Now, this is where things get kind of intuitive, because number 6 is don't close any credit accounts. Now, that seems counterintuitive, because we just said that opening an account could hurt your credit score. But closing an account will also affect your credit scores, because part of your credit score is looking at how much you have available in already extended credit and how much of that you're using. So let's say that you're using only 10% of your $50,000 total available credit. And you say, I've got this credit card over here that's got a credit limit of $25,000. I haven't used it in years. I might as well close it. So you close that out, but now you dropped your available credit by $25,000. So now let's say you're down to $25,000 remaining available credit. But you still owe $5,000. So where once before you were using 10%, now you're using 25%. That will change and damage your credit score. So there may be good times to close out some of your credit, but this is not that time. These are just some basic reminders, and hopefully they don't apply to you. But just understand that any blip in your income, your assets, or your credit should be reviewed and executed in a way that makes sure that your home loan can still be approved. If your job changes, the nature of your employment changes, your job status has changed, talk to your lender. The best plan is to fully disclose upfront. That way you can make sure that everything is ready on the back end so that you can get that mortgage and you can get into your new home. If you have any questions about this, please feel free to reach out to me. Area code 801-556-2259. Or if you would just like a reference for a good mortgage broker, I'd be happy to provide that as well. Again, give me a call, 801-556-2259. Thank you very much for your time, and you all have a good day.